Hi, good day, everyone. This is Mr. Majia H, your lecturer at Central Campus for Finance in Media. In today's lesson, we are going to be covering lesson number 3 according to our lesson plan. So, we are still under the Introduction to Business Mathematics, which is our chapter 1. So, what to read for today's lesson? You need to read the subject outline as well as the roadmap for this lesson before actually going through this recording. The formative assessment one briefing have already been covered in the previous recording, so please make sure that you watch that. It is a separate recording from this one. The textbook that we are currently using is Finance in Media, 4th edition. Today we'll be covering page 35 to page 57. I've also attached a recording of lesson number 3 that I've also done in the previous lessons. So you can use that recording together with the current recordings to gain more insight of the concept that is going to be covered in today's lesson. So the learning outcome for today's lesson are as follows. By the end of the lesson, you should be able to do the following or understand what is required for formative assessment, understand the need for accounting in providing financial information for decision making, understand the accounting process, which require you to understand the basic accounting rules, which include double entry system, which is our accounting equation, recording of financial information. Secondly, the general ledger account, trial balance, and the accounting elements, which is our assets, liability, income, expenses, capital, and drawings. So these elements, two of them are actually also considered to be accounts, which is capital and drawing. They are also considered to be accounts as well as elements. We are also going to require to have basic understanding and rules regarding financial statement, year-end accounting entries and procedures, and applying the accounting theory, rules, and processes. So these are our learning outcome for today's lesson. Recording of financial information. So in the previous lesson, we did manage to cover the concept of accounting, introduce what accounting is, why is accounting important. So I'm just going to read one line and then explain why accounting is important. So here it says that the accounting is a system of recording and summarizing business and financial transactions and analyzing and verifying and reporting the results. So that is what accounting is. So accounting is a process of recording, verifying of financial transaction and summarizing the business results for the whole financial year. So a financial year of a business can actually becomes a starting date which the company started operating, and then it is calculated over a 12 months period. So meaning that if the company was started in June, its year end will actually its financial year start in June and then end in May the following year. So that's how accounting is. So the importance of accounting is that it allows us to be able to track the company's financial performance over a specified period of time to assess if the company is doing well or is doing bad by assessing if we are making any profit or any loss. And then also we can use the accounting information to be able to identify whether the business is worth investing into or how much uh, is this a business actually worth if you decide to actually sell the business, or you want to assess how much is your net worth based on the business that you are currently running. And also the accounting information will also tell you if your business is doing well, what do you need to change, what do you need to improve, and if the business industry you are in is actually doing well or is doing bad, you need to change or move into another business area. So that is all, although are some of the importance of why we do need accounting. So in our previous lesson, we introduced the accounting equation in lesson number 2. So in today's lesson, we are going to cover this into details of what is accounting equation, how can we improve our understanding of the accounting equation. So in the previous lesson, I did mention something which relate to what do you need for you to be able to be successful in the career that you have chosen. You did mention a number of things. Some of you did mention that as a journalist, you will require a laptop, you will require a microphone, you will require a good camera. So, which means that for that business to start running, you will need to put money in the business, which is when the company starts, and then you will use that money and invest it on resources that you will need for you to run that business. So, this means that money will be moving around within the business. So when that money is moving around, so we then refer to this as what we call transactions. So for each and every business, there are going to be transactions that occur. And when these transactions occur, they are then going to be measured or they are going to affect they are going to be defined or allocated or classified according to the following elements. So the first elements that we are going to take a look into, it's what we call the assets. So assets, this is what we actually own as a business. So this means that these are things or resources that we acquire and we actually do have right of ownership over these assets. We can do whatever we like with the assets, either use them to make money or sell them to make money. So these are what we then classify as assets. If you've got money in your bank account, that's an asset. If you buy a new equipment, that's an asset. If you buy a building, that's an asset. So those are things that we do have control over. And then you have got a second element, which is liability, what we owe. So these are the type of people that we will be owing as a business. So to run a business, there will be some times where it will be convenient for the business to go and borrow money or to buy certain things without paying money at the particular time and then pay it at a later stage. So therefore, when that happens, we then have what we call liabilities. These are what we owe. And then we then have owner's equity, which is also referred as shareholders' equity or stockholders' equity. So this is the investment. This is the money that have been invested by the owners of the business, but can also represent the owner's interest in the business, where the owner start the business without using his own money. So there are in a situation where the owner can borrow money from your financial institution and start up a business. When the business start making profit, so that profit becomes or it is the owner's interest in the business, the reason why the business was started in the first place. So therefore, it will be allocated in the owner's equity. So the accounting equation. So in accounting, accounting offers a simple way to understand how these three items relate to each other through what we call the accounting equation. So those three elements that have been mentioned, it's then we then have assets being equal to liabilities plus owner's equity, which this accounting equation is in mathematical form, which means that it can be rearranged. So on your textbook on page 26, you will notice that it starts by saying owner's equity equals to assets minus liabilities. So you can rearrange this equation and then change the assets or use any of these elements to become the subject of the formula. So here we just change it to owner's equity equals to assets minus liabilities. So this means that if the owner, for example, started the business without using his own money, so this means that whatever assets that he invests into and when they grow, so this means that if the assets becomes more than the liability, therefore the difference becomes the share or interest of the owner. So therefore, hence we then have owner's equity equals to assets minus liability. So the normal one that we are going to be using for our assessment is or for our learning purpose, it's going to be the first one, which is assets equals to liabilities plus owner's equity. So where we do have what we call the left side. So this is your left side, left hand side, and right hand side. So they are divided by the what we call equal sum. So this means that when we are analyzing transaction and recording transaction, whatever we record on the left hand side must then always balance and equal what is on the right hand side. So let's try and take a look at the transaction effect on the accounting equation. So the transaction effect on the accounting equation, it says that one transaction might increase both the asset side and the liability and owner's equity side. So to give an example of this is when the owner of the business invests money into the business. So that will be the first transaction that happens if the owner does have capital to invest in the business. So when that happens, the money will go into the bank account, which the bank account is then classified as an asset, and therefore that money will therefore increase the asset side. And then also that money will then have to be recorded as capital contribution by the owner, which means that it will therefore be represented within what? The owner's equity, under the owner's equity. And once that happens, both of these accounts created will therefore be increasing because money came into a business account. The value of the owners in the business account will therefore be returned with the equivalent amount invested. And then secondly, a transaction may also have the effect of decreasing both the asset side and liabilities and owner's equity side. I did make an example during class that with this particular session, sorry, with this particular statement, the owner might decide to withdraw a certain amount of money that he have already invested in the business if he does need the money. So when the owner does that, the bank account will decrease, meaning that money will be coming out of the business account. So meaning that the asset side will then have a minus. And then on the right hand side, which is our liabilities and owner's equity, the capital amount will therefore be reduced. So therefore a second account will be created called drawings, where it will indicate how much money did the owner actually take from the business. The liability side will therefore sit under zero, indicating that there was no changes in terms of the people that we owe. Then at the end of the day, both sides would have decreased. The third statement is that a transaction may cause both an increase and decrease on one side, which is the asset side. This is when we take the money that we do have in our bank account and go and buy an asset. So this means that money that was sitting within our business account will therefore do what? Go down. So our bank account is gonna decrease, but our assets will also increase when we actually buy that asset. So the value of the assets will therefore be recorded on the asset side, and also the money going out will also be recorded on the asset side. So meaning that we'll both have increase and decrease on the asset side. And this will cancel each other. At the end of the day, the value of the assets will still be equal to the owner's equity plus liability. And then the fourth is that one transaction may cause both an increase and a decrease on the liabilities and owner's equity side. So this might actually happen if we decide to pay an expense using an overdraft facility, assuming that we do not have uh, money in our bank account, and then we went and used an overdraft facility, meaning that we are borrowing money to pay for a certain expense that the business will have to cover. For example, you need to go see a client and then you need to pour petrol, so you do not have money to go and see that client. So, which means that you're going to use an overdraft facility. So, an overdraft facility is you using the money that you do not have in your bank account, which the bank allows you to do so, but gives you a limit to say that you can use up to this much. So this means that you are going to then increase the amount of money that you owe to the bank. And then also we are going to have the expense also increasing, which then decreases the profit. So that will be an increase and decrease on the assets and liability side. So at the end of the day, this will then balance off and then give us the same effects from our statement, so from our accounting equation. So here it says that regardless of what transaction occur, the accounting equation must be in balance after the transaction is analyzed. So to be able to analyze the transaction, you will need to understand that for every business transaction, there will be a minimum of two accounts that are going to be affected. So this is also known as a double entry system. So only a minimum of two accounts will be affected. So please note that it's a minimum of two. So there can be more than one account affected, more than two account affected. But for our learning purpose, we are going to focus solely mostly on two accounts. So an account can be defined as a separate record used to summarize the changes in our accounting elements, which then gives us your assets, liabilities, owner's equity, and within these elements, we then have within the owner's equity income. We also have got expenses, capital, and drawings. So those are also considered to be elements, but can also have where the capital and drawings are also accounts. So which means that when we record this, so it's going to then affect a specific account. So what are accounts? So accounts are those things, are those assets or resources that we are paying for and using money. So this means that you are going to then have an account for your bank account and then an account indicating how much value of specific resources you do have. An example, I'll use this to account over here, which is account payable or account receivable. Where account payable, these are the things that you have bought. This is the amount of money that you owe to your supplier. So you bought a number of items from your supplier on credit. So you will create an account indicating how much you owe to your suppliers. And therefore, each and every time you buy something on credit from a supplier, this account will increase. And also when you pay them back, this account will decrease. So these are what we refer as account. Account receivable, whenever you sell something to your customer on credit, the customer, this means that the amount that they did not pay is receivable in the future. So this is an asset to you because the customer still owe you a certain amount of value, and depending on the transaction, if they do not pay you, you might actually have um, the right to take any assets of the customer and sell it to recover your amount depending on the agreement that you entered into. So those are type of assets. So please go and see page 26 and familiarize yourself with page 26. Those are the list, there is a list of accounts that you need to make sure that you understand them for you to understand everything going forward. So you are allowed to refer to that particular page each and every time you go through a transaction so that you can familiarize yourself with when it comes to that particular when it comes to the question that will come during an assessment or during the scenario. So here it says that for each transaction, the following question must be answered when analyzing a transaction and capturing it. So the first question being, what happened? So during this question, we try to understand the transaction by breaking it down, making certain that we understand the event that actually took place. So we are trying to see if we are saying that uh, company bought inventory on credit. So we need to understand that here the company decided to go to a supplier and buy certain goods but did not pay cash and bought these on credit. So this means that we are going to owe our supplier, and therefore we then going to also receive goods that we can sell or that we can use within the company. So that's what we talk about when we say what happened. So we are trying to make sure that we understand the event that actually took place. After that, we then move to the second question, which then talks about which accounts are affected. So during this question, we try to identify the accounts that are affected. So on the first bulletin, I did mention that here you are then going to focus on the two accounts that have been affected, the major two accounts that have been affected. So we can identify that, okay, if we bought something or inventory on credit, therefore we are going to have inventory as one of the accounts. We are also going to have account payable as our one of the other accounts. So the two accounts affected, we can say that we have got inventory and account payables, which represent the amount of money that we owe to our supplier. Inventory representing the value of resource that we received from that supplier. Then the second thing that you need to do under which accounts are affected is then to classify this account as an assets, liability, or owner's equity. So since you receive the inventory, you have got the rights or you own the inventory. We can do whatever we want with it, either use it within the business or sell it. So therefore, this means that we will classify that as an asset. So this means that it will be recorded under the asset side. And then the account payable due to it in nature being an obligation, therefore we'll classify this as a liability because these are people that we owe. So since we bought something on credit, therefore we'll classify that as a liability. And then after that, we then move to the third question, which says, how is the accounting equation affected? So during this particular question, you will be required to determine which of the account have increased or decreased. So that is the first thing that you will actually have to determine in terms of answering the question, how is the accounting equation affected? Since we classified that we do have an asset, we do have inventory, which is classified as an asset. The question now becomes, what are the effects? So is that account increasing or decreasing? So since we bought, that account will be increasing. So our inventory will be going up. So we'll indicate that by a plus sign that it is going up. And then secondly, we then do the same for the other account. Our liabilities are going up. So since we bought something on credit, so therefore we're going to indicate that account payable is going up. So we're going to put a plus sign. So this means that if we were to put the equation down, assets equals to, I'm going to write it in this way, owner's equity plus liability. So this means that here we're going to have inventory and then it's going to be a plus equaling to owner's equity. So here's going to be a 0 plus, and then here we're then going to have our account payables, and then it's going to say a plus. So you will notice that both we do have a plus on this side, we do have a plus on this side. If we did have an amount, we're going to have 20,000 here and then 20,000 here, indicating that at the end of the day, our accounting equation has to balance. So the transaction effects of accounting equation continues. So here it says that if the company continues to keep accurate record using the double entry system, the accounting equation will always be in balance. So meaning the left-hand side of the equation will always be equal to the right-hand side. So here they've given you us some few examples to understand the effect of transaction in the accounting equation. Here it says that, for example, when the company borrows money from the bank, the company assets will increase and its liability will increase by the same amount. So our bank balance will go up, and also our loan or our the money that we owe to the bank will also go up since we received more money from the bank. When a company purchases inventory for cash, one asset will increase and one asset will decrease. As an example, so this is one of the effects that can actually happen within the this is one type of transaction that can occur within a business. So using the money that we have to buy other resources to help the company generate profit. So here it says that because there are two or more accounts affected by every transaction, the accounting system is referred to as what we call a double entry accounting or bookkeeping system. Now, for every account, there is a left side and a right side. And the left side is called the debit side, and the right side is called the credit side. So, for each and every account that is going to be affected, that we're going to record on our accounting equation, we will then have to classify the account as an asset, as a liability, or as an owner's equity account. So for each and every account, we'll then have the left side and the right side. And to determine whether which side does the account increase by, will therefore be classified based that will therefore be determined based on the classification of that account. So not all account increase on the left side, and not all account increase on the right hand side. So to summarize this is to put it in this format, which makes everything much easier to understand. So for each and every assets account that is going to be classified. So here we say that this is the debit side, which is denoted by DR. This is the credit side, which is noted by CR, and then also this side DR, this side CR, DR meaning debit, CR meaning credit. So for each and every account that will be classified under the asset side, they will all increase on the debit side, and then they will all decrease on the credit side. So to make an example, if the owner of the business invests money, and we say that we do have a bank account. So when the owner invests money into the bank account, the money will be recorded in the left side of the bank account because that's where the assets increase by, since bank is classified as an asset. Whereas on the owner's equity side, the capital account will be affected, and when it's affected, this means that it will therefore be recorded on the credit side to indicate the increase of the capital account of the owner. So this therefore means that for both liabilities and equity, due to them being on the one side of the accounting equation, they will have similar treatments. They will both increase on the credit side and decrease on the debit side to make sure that the accounting equation always balance. So one of the most important thing to be able to note over this section over here is that within the owner's equity, we are going to have the following type of other elements. This means that anything that has to do with capital will therefore be reported within the equity side. And then we're then also going to have drawings. We're then going to have income, and then we're going to have expenses. So what happened is that capital and income will both be sitting on the credit side of the equity, and then both drawings and expenses will sit on the debit side of the equity. The reason being that capital uh, is the amount of money that or interest that the owner have in the business, and drawings represent the amount of money that the owner of the business took away from the business to use for personal use. So this then decreased the owner's interest in the business. So this means that you therefore have to record it on the debit side, showing that it is decreasing the interest of the owner. And this account, the increase normally by themselves, the increase on the debit side, all expenses are almost treated like assets, the increase on the debit side. But over here, we're going to record them as a minus, indicating the decrease in the owner's interest. Expenses, uh, at the end of the day, the profit belongs to the owner of the business. Therefore, to record the profit of the owner, will then record it within the owner's equity. So this means that income will be represented on the credit side of the owner's equity, showing the amount of money the owner is receiving from selling or rendering services. And then once that is done, the owner will also record all the expenses incurred, indicating how much he incurred to generate specific revenue. And the difference from there will then either determine whether the owner made a profit or either a loss, which is going to, if it's a loss, it's going to show a decrease on the interest on the shares or shareholders' interest in the business, or if it's a profit, then it's going to increase the owner's interest in the business. So this is in summary of the effects of the accounting equation of transaction. This is the transaction effect on the accounting equation in summary. So over here you then have your liabilities. So on your liabilities, they both increase on the credit side and also decrease on the debit side, similar to your equity. So if we buy anything on credit, so your liabilities account will be credited all the time because the amount that we owe will always be increasing. And then whenever we pay our creditors, therefore we are going to debit that creditors account, indicating that it is going down. The amount that we owe is now going downwards. So those are the summary in terms of the effects of accounting equation. So let's take a look at some of the other um, transaction or other analysis of transaction and where to record them in terms of the accounting, in terms of the accounting rules and processes. But we're then gonna come back and focus on trying to understand more about the transaction effect on the accounting equation. So our focus for this semester is going to be understanding the effects of accounting equation and preparation of financial statements. So during the course of the business, transaction can be recorded in the following journals. The company can have these following journals, which the first journal is the sales journal. Whenever we sell something or render a specific service, then we're gonna record that within the sales journal. And then also, whenever we receive any income from operating the business or from other business operations, then we're going to record that under the cash receipt journal. And then also, to run the business, there are going to be some expenses or costs that we'll have to incur. So then this will therefore be recorded within the cash disbursement journal, which is also known as the cash payment journal. And then when we buy anything on credit, then it's gonna be reflected within the purchase journal. And then also then gonna have the general journal, which then records the movement of each and every account separately. So that is then done within the general journal and therefore then be transferred all of these in the general ledger, which then represent the summary of one specific account. And then over here, we then have got the following, which I've already explained that these are the elements within the accounting equation. We've got your assets, liability, and owner's equity, where the elements in terms of the accounting equation that can be classified, we've got assets, liability, income, expense, capital, and drawings. Whereas I also indicate that these two are also classified as accounts. So the rules of double entry are as follows. is that for each and every accounts that there is, so this please refer to page 26. You will see that we do have accounts listed on page 26 under each and every element that have been mentioned over here. So on the assets, it says that all the assets account will increase on the left side, which is the debit side, and decrease on the credit side. All liabilities will increase on the credit side and then decrease on the debit side. And then all the accounts expense will increase on the debit side but decrease on the credit side. So this means that since the assets are going to be represented within the owner's equity, so we're going to record them this side as a minus, but remember, we're going to record them as a minus on the owner's equity as they will be decreasing the owner's interest in the business, and therefore we'll be able to use them to identify whether the company managed to make any profit or loss. But by putting them on the debit side all the time, this will also be increasing that particular what expense account. The more it repeats here, the more that account actually grows. So, but if the account is represented alone, separately on the general ledger, therefore, it will indicate by showing on the debit side that it is increasing. And then the owner's drawing as well, due to it being uh, having negative effect on the owner's equity, it will be therefore sit on the owner's equity side, but we'll use a minus this time on the accounting equation to indicate that it is decreasing the owner's equity interest. But on the ledger account, on the drawings account itself, we will record this on the debit side by showing a plus sign that the owner is taking more money out of the business, and this is how much the owner have taken out up to today's date. So this is gonna increase on the debit side, whereas also here it's gonna be reflected on the debit side, but it's gonna show as a minus under the accounting equation, indicating that the interest of the owner is decreasing. The owner's equity will therefore increase on the credit side and decrease on the debit. If owner invests money, then this money will therefore be reflected over the side by increasing the owner's uh, share on the business. All income accounts will also increase on the credit side and decrease on the debit side. So that then gets to summarize everything that you need to know before we can start with trying to perform some activity in terms of the accounting equation. So just to go back to our summarized vision of the transaction effects. So we say that for each and every transaction that is going to occur within the business, you will need to ask yourself the following three questions, which also have got sub statement or sub questions that you need to make follow up of for you to be able to allocate the transaction accordingly and make sure that everything balanced at the end of the day. So the first thing that you're going to do is to analyze what happened, which is to make certain, which makes you certain understand the event that took place. And then secondly is to ask the question which accounts are affected. So you need to identify the accounts that are affected. So we said that there are a minimum of two accounts that are affected. So which means that you're going to identify those two accounts affected. Once you identify those two accounts affected, we then have to classify from the two accounts affected, which one is assets, which one is liability, which one is owner's equity, or are they both assets, or one of them is liability, or one of them is owner's equity. So we are going to then, after that, identifying those two, classify. Once we are done classifying, we then move to the last question. How is the accounting equation affected? So here we determine which account increased and which account decreased. So once we are able to classify which account, the last thing is to then ask, since this is an assets and we have tried to understand what actually happened, which tells us whether this type of resource is increasing or decreasing. That's what we are going to then explain here, that this account is therefore increasing, this account is therefore decreasing. And then after that, we then try to put that effect by saying that we then debit that account since it's an asset and assets increase on the debit side. If that asset is decreasing, we then say we credit these assets because it is decreasing. So then we then indicate by creating the account and also putting a minus indicating that it is actually decreasing. Then the last thing that you need to do is to make certain that the accounting equation balance after recording the transaction. So this is the most important thing. Does your accounting equation balance at the end of the day? So let's analyze the effect of transaction on the accounting equation for Lali Media Company. So we do have the following example. Lali is the owner of the business and she invested 125,000 in the business. So when trying to follow the same step and process that I've just explained earlier on, we are going to ask of ourselves the following question. What happened? So during this period, we're going to ask ourselves what happened. So here we'll then understand that Lali actually took 125,000 from a personal bank account and deposited it into the new account in the business name. So one of the most important things that I always try to emphasize during this lesson is do not look into the business as is someone's business. Always look into a transaction as if you are the business yourself. You are running the business. You personally are the business. Treat the business as yourself as an individual, then you'll be able to have a better understanding and insight when you actually go through trying to understand each and every transaction. So the most important information here is that she deposited money into the new account in the business name. So that is what we are looking into. What happened on the personal account, we are not currently focused on that because we are the business. So we focused on ourselves, the business. So this means that money came in into our business account. So our business account, which is the bank account, is going to then have money. But how? Then the second thing is then going to be uh, what accounts are actually affected. So to identify those accounts that are affected, we need to identify what actually happened. So the first thing that we do notify is that the money went into our what we call a bank account. So this can also be named as bank account. So this is our bank account. Money went into our bank account. The second account that needs to be created is the account that indicates the owner's interest in the business to indicate how much did the owner invested in the business, which therefore, since the owner is the one that invested the money in the business or deposited the money, therefore we're going to create an account called capital, which we're going to name it. We're going to also write the name in front or the name before indicating that this is Lali capital contribution. So once we have identified and this account, so the second thing that we need to try to do is then classify this account. We do have bank account which was affected. We do have capital that was affected. So within these two accounts, which one is assets or which one is liability, which one is owner's equity. So we need to classify these according to the three elements on the accounting equation. So once we are able to do that, then we can then ask ourselves the last question: how was the accounting equation affected? Was there an increase or a decrease in that account, or was there um, a decrease or increase in that particular account? So classification of account, the bank account will be classified as an assets because we do have control over this or we do own this bank account. We can use the money according to the way we want. And then the capital side, we then classified this as an owner's equity, which shows interest of the owner in the business. Then the third question then becomes determine whether the accounts have increased or decreased. Therefore, in this case, we're then going to have the cash account or the bank account increasing. And then the capital account will also increase, indicating the share of the owner also going up. So then now that we do have this, let's put this down into an accounting equation. Does the accounting equation balance, which is the last question? So over here, we then have assets equals to liabilities plus owner's equity. So we did mention that cash or bank is our assets, so it's going to be increasing. And then owner's equity, we do have the capital account, which is going to be increasing. So this means that we need to indicate by the plus sign that our asset is going to increase by 125,000, which is the money that went into our bank account. The owner's interest will also increase by 125. Then the question becomes, did our accounting equation balance? So you can see the left-hand side is equal to the right-hand side. Therefore, this means that it is balanced. So it does balance, as you can see from our transaction. So during class time, I did ask you guys to perform this particular activity. So indicating the accounts that will be influenced by the following transaction. Also indicate whether the account will increase or decrease. So over here, so we are looking for the account that will be debited, the account that will be credited. So the first thing that you need to do for this transaction, this is a summary of a transaction, is to try to identify if we say the owner deposited capital, uh, what actually happened. That's the first thing that you need to analyze. Secondly, which accounts were affected, identify the accounts, and then classify the accounts. And then lastly, what was the effect on the accounting equation? Did that account increase or did that account decrease? So another simple method for you to understand once you identify the account, before classifying the account, try to understand, try to also factor in the third question. Did or what was the effect on that account? Instead, what's the effect on the accounting equation? Ask yourself, what is the effect on that account? Let's say the owner deposited capital into the owner deposited capital. So which means that the owner took money and then invested into business account. So meaning that the bank account of the company will go up. So that is the first thing. So that is trying to identify the accounts and also what is the effect on that account. So the money came in the bank account went up. The owner invested money, his share of interest also goes up, so the capital also go up. So then once we then move from that stage, we then classify this account. We are saying that there is a bank account, it went up. So what is a bank account classified as? So is it an assets, liabilities, or owner's equity? It's an asset. So since it's an asset, therefore assets increase on the debit side because this bank account is increasing. So this means that over here we're then going to have plus, and then we're going to have that bank account. And then over here we're then going to have the other account, which is capital, which is therefore capital, which is also a plus because we are saying that it's increasing, and then the owner's equity side increase on the credit side. Hence, we then credit the capital account. Second one, sell goods for cash. To a customer. So when we sell goods for cash to a customer, this means that we are going to be receiving money from that customer in cash, which is going to go straight to our bank account. And then also our sales are going to increase. So this means that sales will also go up. So then we have managed to identify specific accounts. So we are saying that we do have bank and we do have sales. And we're saying that since we're selling this on cash, bank is going to increase as well as sales increase. Then the question becomes which account do we debit, which account do we credit? So for us to be able to identify which account to credit, which account to debit, we need to classify this account. Which one of these is an asset or liabilities or on security? So the bank is classified as an asset, and since it's an asset and it's increasing, therefore the bank will increase on the debit side. So this means that we're going to have plus, and then we're going to have bank, which is going to be debited. Over here, the sales is an owner's equity account, and therefore it increases on the credit side. So therefore, we are going to say plus sales on the credit side, showing that the account is credited. So I will leave the rest for you guys to complete. If you do have any question, please ask or send me to confirm if you have managed to get the rest of these answers correctly. So I will just identify the accounts, and you guys will then tell me which one was debited, which one was credited if you are practicing and you require solution. So sell goods on credit to a customer. So when we sell something to a customer, we then have the account called account receivable. So the amount of money for the goods that we sold for, it's a receivable. So we then can create an account receivable. And then also sales is also going to go up since we are selling some stuff on credit. So these two accounts will therefore be affected for this. So you need to identify and tell me which one is increasing and what is the accounting effect. So I will say for this one, both are increasing. People who owe us are increasing. Our sales also went up. Then you're gonna tell me which account is to be debited, which account is to be credited by classifying this account either as an assets, liabilities, or owner's equity. The same person that actually bought on credit, which is also known as a debtor. So a debtor represents the term for someone who actually owe us money. So the account receivable can also be written as what we call debtor's control, indicating the amount of money that we are being owed. So here it says that the same person that owes money makes a payment to pay off the account. So when they pay off the account, account receivable will also be affected. And then also our bank account will be affected since money will be coming in the business. So both of these, this one is a minus, this one is a minus, and this one is a plus. So you need to identify which classification of account do these fall under. Do they fall under assets, owner's equity, or liability? And then on this one it says buy stock for cash. So when you buy stock for cash, bank is affected, and then also inventory that you are buying also increase. So the bank goes down, the bank amount goes down, and then the inventory increase since the money is coming in the business. And then on the last one, on the second last, it says purchase stock on credit. So when you purchase stock on credit, you're gonna have account payable, and then also gonna have inventory. So both of these are increasing. The amount that we start owing our supplier will increase since we didn't pay this when we bought it. We bought it on credit. And then also our inventory also gonna be going up because now we did receive a certain amount of stock or value, so therefore the value of stock goes up. So then you need to also classify. Once you classify and understand that this is increasing, then you then can classify whether it increase on the credit side or on the debit side based on the classification. On the last one, it says pay creditor. So when it says pay creditor, account payable is going to be affected, and then bank is going to be affected. So this one is going to be minus, and also this one is going to be minus. So they are all minus because now money is coming out of the business account going straight to the supplier account. So this means that when it goes to the supplier account, we now owe less from our supplier. So please make sure that you do practice this activity and try and fit in which account is to be debited, which account is to be credited based on account classification. Once you understand this concept, you understand the process of recording financial transaction within the accounting equation. So over here, we then do have an accounting cycle. So with the accounting cycle, it focuses on how information is recorded during the financial period. So we then gonna have to analyze a transaction. When a transaction occur, we analyze the transaction. We then prepare the journal entries of that transaction. If you still remember the cash payment journal, the uh, cash receipts journal, the sales journal, the purchase journal, the general journal, and then we then have our post entry or post journal entries. From post journal entries, these are type of transaction that occur at the end of the month once everything has been recorded. And then we then have to prepare what we call unadjusted trial balance. So unadjusted trial balance will then include all the balances from the accounts that we have created from the general ledger account, and then we'll then make journal entries with adjustment journal entries, which are those transactions that occur on the last date before the publication of financial statements. And therefore, once those are adjusted, we then can have an adjusted trial balance, which is also called a post trial balance. The trial balance is then used to create or to prepare financial statements. And from this, we then go and once we prepare the financial statement, we then, if there are any other transaction, we prepare closing entries, and then we do the post-closing trial balance, and then the cycle continue. The cycle continue every year. We then repeat the same cycle. So that is the cycle of accounting cycle. So earlier on, we did talk about the general ledger accounts. What are general ledger, and how do you identify or how do you prepare a general ledger, or when do you do that? So a general ledger is prepared secondly after, it's prepared thirdly after the information have been recorded in the journals of the company. So you're going to have your source document first, then you're going to prepare your journals, which indicate the amount of money you received or the amount of money you paid or those fees that you have incurred. And then from that point, we then have your ledger account, which is your T account, that we did mention that for each and every account, you're going to have the debit side and then you're going to have the credit side, which determine whether the account is increasing or decreasing. So with the general ledger account, there are two types of categories when it comes to the general ledger. We then have what we call the balance sheet account, and then we then have the nominal sheet account. So the balance sheet accounts, these are type of accounts that requires us to balance them at the end of the day. So this means that money, for example, if we to take a look at the bank account, there will be money that comes in which will be recorded at the debit side. There will be money that goes out that will be recorded on the credit side. So at the end of the day, these have to be balanced to indicate how much money is left within the bank account. So when it comes to your nominal account, so your nominal account include things such as sales. So when it comes to sales, what normally happen over this account is that we are going to record all the amount of sales that we made. Once we record all of that, we then just we do not balance, we just only calculate the total of sales that we made during that year. If sales was returned, and then we're then going to have a sales return account where everything will be recorded on the credit side, on the debit side, which decreases the total number of sales. If we are putting this in the accounting equation, under the owner's equity, because all sales will be on the credit side, indicating an increase in owner's equity, and then all returns will therefore be on the debit side, indicating the decrease on the credit side. But on their own specific account, the sales return will therefore decrease will be recorded on the debit side. So this means that all income accounts will therefore have a record on the credit side, and then all expense account will then have a record on the debit side, indicating how much they've grown by or how much we have incurred over this particular assets, over this particular account. So here it continues to say that the balance sheet accounts are all your assets, liability, capital, and drawings accounts. So these accounts are balanced off by calculating the difference between the debit and the credit side of each account. So there will be two categories which we call the balance carried down and the balance brought down. So the balance carried down will be the balancing figure, and the balance brought down will be the one that we is going to open the account in the following month. So to make an example is to say that on the bank account, if 100,000 was in our bank account, this is our bank account, and then we went and used 20,000. So therefore, we are going to balance this by saying that the total biggest side is this side which we're saving 100,000. So we balance by the biggest side. So this is the biggest side. And then we then go and say 100,000. So this side is the smallest side. So we're going to have balance carried down, which is 80,000. And then over here, we're then going to have balance brought down, which is 80,000. And then this will therefore be the opening balance in the following month that is coming. So this is what this actually means when we say that at the end of the day, the balance sheet accounts will then have to be balanced, and therefore each account will therefore be balanced, and then we'll have a balance carried down and balance brought down. Whereas nominal accounts, whereas all nominal accounts in your income and expenses, these are your income and expenses. So these accounts are not balanced off. However, they are totaled for the specific financial year. They only represent one financial year and will then be closed off. All nominal accounts will be zero at the beginning of the financial year. So to summarize this is to go and say that for each and every nominal account that is going to be there within the company, uh, we're going to only record specific information for one financial year. For example, if your company was registered in January, its operating cycle is 12 months, so it's January to December. So this means that when we start January next year, your sales, your fuel expenses, accounts, all these accounts are going to start from zero. And then we're going to start tracking the sales that you made during that year from zero up to whatever amount of money you made. Whereas on the balance sheet accounts, these are the type of accounts that fall within your assets, liability, capital, and drawings. These assets, these accounts will therefore have to be balanced, and the balance that was remaining at the end of the year will therefore be transferred to the following year at the beginning of that other year. So it is a continuous process that gets to be recorded. So these accounts, they do not start from zero, they start from the previous month balance. So a T account, which we have mentioned that an account will be affected. We did mention that the account will be affected. There will be specific account affected during a normal transaction. So each and every account will then have what we call the debit side, which is the left side, and the credit side, which is the right side. So when you do record on your ledger account, you're gonna record the month and the year of the transaction, and then the day, and then after that the account that is affected, which is the other account, and then the amount. So what normally happens when we are dealing with a T account? is to go and say that if, let's say, this was the bank account, money came in the bank account which was deposited by the owner um, on the 1st of March. So here we are going to say that 03 slash 2025, and then over here we're going to put in that it was on the 1st, and then we're going to say capital. So here we're going to say capital, and then we're going to say 100,000 was invested by the owner. So this is happening within the bank account. This means that when we go to the capital account, we're going to go to the credit side and write that money was deposited in the bank account on the third month of 2025 on the first, and the amount is 100,000. So this is how we get to record. So once you have got an account open, you will indicate the transaction by recording the other account that was affected. We did mention that there will be two accounts affected. So within each and every of those accounts, the other account will also be reflected to indicate that the money also came from this account or went into this account if it was coming from the bank account going to another account. So this is how the general ledger actually gets to work. This is the framework of the general ledger T account. This is where we get to say that we debit bank and then we credit capital. So this is how we explain it in the general ledger account. So these are the description of the general ledger accounting headings, accounts headings, so which I've already explained most of them. So this is a summary or an example of a balance sheet account indicating that the owner of the business invested uh, the owner of the business invested 20,000 on the 3rd of January 2023. And then the second thing that this owner did was that on the same month, he went and bought equipment worth 10,000. And then again on January, this person went and pay his creditors. So the bank account decreases on the credit side because then asset side. So this is the balance sheet account. So it is decreasing. So we fasted by doing all of these transactions before the year end. At the end of the year, we then do the balancing. So on the 20, he paid salaries of 1,000. On the 22, he bought inventory worth 6,000. And then after that, on the 25th, he went and made sales of 30,000. So these are all the transactions that opened in January. So once all the transactions for the month have been recorded, we then have to balance off the account. So these are balance sheet account. Anything that was classified as an asset, liability, drawings, or capital have to be balanced off. So on the bank account, we're then going to balance it based on which side has got the biggest amount. So the debit side have got the biggest amount, so therefore we're gonna balance it based on the debit side. So we're gonna have 30,000 as the balance, as the total, sorry. We're gonna total it off based on the biggest side. So this is the total. So this side, the total is short than the debit side. So we're gonna add everything over here and subtract it from the total. And then we'll then gonna have a balance carried down of 8,000. So this means that on our bank account by the end of the month, we had a carried down balance of 8,000. Then on the month of February 2023, the balance will be brought down from the previous month, which is January, and therefore we'll start the month with a balance of 8,000. So this is just to summarize the balance sheet accounts, how we balance it, and what is the explanation of balance brought down and the explanation of balance carried down. On the sales account um, will only indicate all the sales that have happened during the year. So we did on January 23, 2023, we sold stock on credit to our customer, which is account receivable, for 25,000. So sales will increase by 25,000. This will be represented by account receivable to show that this is the customer that bought the stock. If it was a cash customer, then it was going to say bank over here. As you can see on this one on the 25, this is the customer that paid cash, which is 10,000. So he bought stock from us worth 10,000. And then this one bought stock worth 25,000 but did not pay us. He bought on credit. So therefore, we're going to have account receivable. So due to sale being classified as an income account, therefore, it's a nominal account. So therefore, we do not balance it off. We just write the total. So the total becomes 35,000. So we only have balance brought down. And that is it. So this means that these accounts are then going to be used to create an income statement. Since the nominal accounts are only income and expense, we use them to create an income statement. And the balance sheet accounts, we use them to draft what we call your um, balance sheet statement. And then lastly, from your ledger account, we then transfer those total and balance. Remember, on the balance sheet accounts, which are those classified as assets account, liability account, um, owner's equity account, such as drawings and capital, we then transfer their totals, which is the balance carried down, so the balance brought down to the trial balance. And then on your nominal accounts, which are your income and expense account classified, therefore they will then go to your trial balance as well. So on the trial balance, we'll then have to separate these accounts by saying that now we have what we call balance sheet accounts and then as well as nominal accounts. So please just press the ring and say balance sheet account. So this will be your balance sheet accounts. So these are all accounts classified as assets. So over here we've got sorry, we've got assets. So we've got account classified under assets, liability, and owner's equity. Only those that are classified within here are listed within the balance sheet account. And any account classified as an income account or expense account, therefore they are listed within the nominal section. So the most important thing is to understand that for each and every assets account, we expect that they will have mostly a debit balance. So this means that bank, we expect it to have a positive balance, but at some point in time, you might overuse the money that you have in your bank account and it might go to negative. That's when we're going to have a credit bank balance showing that you owe the money to the business capital. It increased on the credit side. So therefore, this one will always have a credit balance. Account receivable is an asset. So account receivable is over here. And then account payable, these are people you owe, so we expect them to be on the credit side. And then inventory is an asset, so therefore it will be sitting on the debit side. When it comes to income and expenses, all income increase on the credit side, so we expect your income to be represented on the credit side and all the expenses to be on the debit side. So interest income, this is an income, so it increases on the credit side. So and donation, depending on the type, if it's donation received, therefore it's gonna be on the credit. If it's donation paid, therefore it's gonna be sitting on the debit since it's going to be an expense. So over here we do then have an activity that has been designed for us to do it in class. So we are going to cover this in then our next class. So please make sure that you attend. I'm going to explain all of these during class time. You will not be assessed on preparing general ledger and trial balance. However, I am going to explain this in class so that you can be able to gain and understand this concept. So this is just a summary of the previous activity that have occurred from 1 to 25 of March 2021. So this was recorded on the balances, and now you have to indicate what was the balance for all the assets, liabilities, and equity uh, transaction, and then also indicate the totals for those other accounts which are non-balance sheet accounts, which are nominal accounts, and then later post all of these to the general to your trial balance. So the most important thing over here is to understand that also your trial balance at the end of the day needs to balance. So whatever total you have on the debit side should be exactly the same as the one on the debit side, because at the end of the day, the trial balance is summarizing all the balances of movement of money within the business during a specific financial period. So this means that at the end of the day, all of these has to balance. So this then conclude our lesson for today. So please make use of example 1H for you guys to be able to understand the double entry system and how it works. So on the next coming lesson, we are going to have some few activities that we are going to perform in trying to gain more insight of understanding of how to prepare the accounting equation or record financial transaction using the accounting equation. So this then brings us to the end of our recorded lesson. So please do attend the next coming class, as we are going to be doing some activities, including summarizing example 1H, since there is a solution on your book. So please make use of this opportunity to try to perfectly practice your understanding of this concept. So this will be all from my side. You will enjoy the rest of your day. We'll meet on our next lesson. Thank you very much.